And welcome to Your Finance TV. We're here with Jeffrey Huge, founder at Alpha Insights. Jeff publishes weekly playbook on Sunday night, which is available on Substack at hugeinsights.substack.com. So it's been an August week since we last spoke, Jeff. Not very much activity, some news flow, but nothing really that impactful. How are you doing? How was your weekend? How was everything? It just seems a bit of a blah, really, right now, doesn't it?
Yeah, it's the summer doldrums, isn't it?
It certainly
I
is.
guess the CPI and PPI last week were kind of the big headline news, right? And the CPI was a little bit of an upside surprise, and the PPI was a bit of a downside surprise. And I think a lot of people are wondering what's going to happen when we start to see oil prices, showing up in that PPI data and following into the CPI, right? Because gasoline prices, gasoline futures, anyways, are up 18% in the last month. That's not going to go unnoticed in terms of the consumer's behavior.
So we'll start seeing everything edging up, that's for sure. And it certainly is. So before we dive into your weekly piece, Jeff, I just want to remind our subscribers, make sure you like and subscribe. We're edging up on 4,000 subscribers, I believe. So thank you for your growing support. But as we do always, Jeff, why don't you kick us off with the top down?
Sure. I think we start off by just saying that last week was pretty much an unch week, right? The S&P was, up fractionally, I think, or down fractionally, whatever it was more or less essentially unchanged. And, from that perspective, a lot, did not occur. But if you look under the hood a little bit, you can see that quite a bit did occur. For example, NVIDIA was down some 8.5%. This is, the AI darling. Of course, it reversed all that yesterday. So, it's kind of, a back and forth market, I guess is what I'd say. You've got a lot of indecision. There is a Jackson Hole meeting coming up in, a week or so. And that's going to be the next real big focal point for the street from a macro perspective. But our work continues to suggest that the S&P 500 has likely seen the peak for its recovery rally. And as we have been advocating for really a defensive posturing in terms of positioning. Our clients have gotten this message from us for a number of weeks now. Patience is a virtue, right? Minimize net equity exposure and maximize cash reserves. We love 3-month T-bills at 5.5% right now. We think it's the fattest pitch in the market. And when we dig deep into the fundamental backdrop, we see three things standing out as being high probabilities. Number one, over the next 12 months, we think it's a high probability that the U.S. enters recession. We're already seeing struggling China data, day after day. And I think last night, we got kind of the cherry on top, so to speak. They missed across the board, and the People's Central Bank cut rates by 10 basis points. Doesn't seem like a lot, but when you're at 260 and you go to 250 or whatever it was, it makes a difference, right? And so we're seeing a looser, more supportive sort of policy from Chinese authorities, and a lot of the bullish sentiment that had existed over the last couple of weeks was really driven by this recovery in China story. That was going to be the next leg of the advance, right? We'll see. I think the other thing that we need to really focus on is how earnings are evolving, and I think the second quarter came in from a street perspective better than expected, but down, right? So 3 consecutive quarters of down earnings now. And a lot of people really have this notion built into their models that the back half is going to be epic, that we're this huge move to the upside, right? It's not going to happen, okay? We're going to continue to see pressure on earnings going into the end of the year. And one of the reasons for that is, as we talked about, this pass-through in higher energy costs, I think, are going to be a big issue. We're also seeing creeping up of the dollar, right? And long-term treasury yields. And all these things are big headwinds in terms of the earnings picture and the economic backdrop. And so, with that said, we continue to have a cautious stance.
So, Jeff, first of all, on the China side of things as well, overnight, I don't know if you saw, but they were saying they were considering cutting stamp duty as well, which is the first time since 2008, which they're trying to prop up and get people more involved back into the equity market. So, a lot of things coming out there, as you mentioned, a lot to watch and obviously a lot to be concerned about, which I don't know if is necessarily being digested so much, but we will continue to see how that pans out. Jeff, this week your piece kicked off with advisor sentiment. Now, again, here things are looking pretty bullish as well, right?
They are. Investors Intelligence is a service that's been around for almost 50 years. They conduct a weekly survey of advisors. These are the publishing advisors, right? Someone like myself, right? In fact, I'm included in the data. And what we're seeing is advisors, and a few advisors are neutral, right? Or they're looking for a correction, or they've got a tactical trade. Those aren't their real opinions. Those are, kind of we're not making a call. So we really want to focus on bulls and bears, right? Who's making a bullish call? Who's making a bearish call? And we look at the bulls relative to bulls plus the bears, and we're at a 4-week moving average of around 75%, 75.4%. That's actually a multi-year high, and it exceeds the level of 71.8% that existed back when the NASDAQ complex made its all-time record highs in late 2021. The November 2021 peak in NASDAQ stocks. S&P peaked a month and a half later on January 4th, and the Dow a day later on January 5th. And so, the sentiment picture is actually more ebullient today than it was when stocks were making their all-time record highs. And the problem with that, Mehdi, is it tends to coincide very closely with big turning points in the market's trend. And so if we're in the neighborhood of a major turning point, it is being punctuated by the fact that advisor sentiment is at a multi-year extreme today.
So, Jeff, now rolling through this, how are futures traders positioned? Has there been an active change in this recently?
There has, Mehdi, and in fact, this was part of the narrative that really supported the advance coming into this year, is the fact that everybody was so bearish at the bottom, at the October lows, and also recall that the Nasdaq didn't bottom until late December, and so we had a very large cohort of bears positioned bearishly into the end of last year and coming into the beginning of this year, and that reversed. It reversed shockingly to the point where we got up to kind of a complete reversal of that bearish positioning, right? But then it went back in favor of a short, right? And so what we do is we look at the S&P E-mini futures contract. It's the most actively traded by large specs. And large speculators had a position in excess of 400,000 contracts net short, which was excessive. That exceeded the levels at the end of the year. And so, a lot of people were rightfully saying, hey, everybody's positioned bearish. The positioning, again, is kind of lopsided, right? And who's on the other side of the trade? Well, the commercials. But who are the commercials? Well, the commercials are, they're trend followers, right? They're the CTAs, they're the vol community, they are the risk parity community, they are the dealers, right? And all of these folks are taking the other side of those futures trades. So it's a paired off bet, right? But when you're 400, when you have your leveraged speculating community net short over 400,000 contracts, it does lean lopsidedly bearish extreme, right? Well, that is completely unwound from its extreme condition to about just 150,000 contracts net short and net long by the commercials. And that's right in the realm of normality, right? It's just normalized at this point. There isn't a lopsided extreme by the bears. Now, there's leveraged speculating community continues to have a slightly bearish bias, right? Compared to history, but it's not ridiculous at this point. It's not overstated. And in fact, open interest has shrunk by a third. And so when we take a look at the 10-week moving average of open interest, it is rolling over, and it appears that there's a lot less gambling going on, if you will, in the market. People are coming down to maybe more of a wait and see sort of posture, right?
Well, we prefer wait and see to gambling, that's for sure. So, Jeff, you mentioned this last couple of weeks as well, the 10-year Treasury yields, and they seem to be going onwards and upwards as you've been kind of pushing towards.
That's right. We've been talking about this for weeks, and we have identified a classic pattern base formation of the inverted head and shoulders variety in the 10-year Treasury yield. And so the chart that we're looking at really kind of illustrates the breakout that we think is underway right now in 10-year Treasury yields. We currently, I believe, are trading around 423 last time I looked. We think if this follows through to new cycle highs, which we're only a few basis points away at this point, we should see a fairly rapid projection to the upside into the 5.5 range. We've got an initial target of 495 and a stretch target of 440 looking out the next 12 months. That's for the 10-year Treasury yield.
That's very punchy. Let's have a look at some technicals. Looking at the cycle degree Elliott Wave analysis.
Yeah, essentially unchanged from our prior view. We have two counts that we present every week. The first on the left-hand side is our preferred count. The preferred count is unchanged. We think that the market basically topped at both cycle and super cycle degree back in January of 2022. We think the initial decline into the October low was primary wave one down of a 5-wave impulsive decline that is just in the very early stages. Once complete, that'll end cycle wave A down of an ABC corrective pattern at super cycle degree, which could take years to unfold. The rally off that October low is primary wave two up, and that is traced out a zigzag pattern. Now, if we take a look at this from another angle, right, the alternate count, we've been under some pressure from clients just to kind of acknowledge the fact that the market is traded much higher than we initially expected. And what if we are in a new bull market? Well, we doubt it, okay? This is a low probability alternate count. And it's actually our number 2 alternate count. We showed our number 1 alternate count last week. The number 2 alternate count suggests that, maybe the advance into the, January 2022 high was not the end of cycle wave 5. Maybe it was the beginning of primary wave 5 of cycle wave 5. And if so, that would have been intermediate wave 1 up. Now, we think that's a long shot because that would make intermediate wave 1 up the longest intermediate wave 1 of any that we've seen, in this particular, cycle, right? So I don't think that's the case. But if it was, then we can look at the pullback into the October low as being intermediate wave 2 of primary wave 5 of cycle wave 5, which means that we're going to go to epic new highs, right? Carrying the market at least to 5,500, and that might only be primary wave 3. So we think this is a very low probability outcome. It doesn't really jive well with the rest of our analysis dating way back, and we're not showing all the details of that this week, but our clients are well aware of it. And the other thing is that the valuations are out of sync with reality. I mean, to get to 5,500 would assume 20 times the street's 2025 estimate of 274. First of all, we think that estimate's ridiculous. We don't think we'll ever see 274 in earnings. We think earnings peaked, okay? And we think earnings are headed way lower. We think they're going to 187 next year, and they're not going to jump by almost $100. And so, that's just, it's not going to happen is our view. So, let me just emphasize the fact that our preferred count is the count that we're working on. And this is just kind of, what if? And we'll have to see. The market would have to make a new all-time high in order for this count to be even within the realm of possibilities.
So, Jeff, thank you for highlighting the alternate count. And obviously, it's a very small percentage chance of this happening in your view. You highlighted that that could potentially break out. If it did happen, would be like a 5,500 type of level potentially. Let's have a look at the primary degree Elliott Wave analysis, because this is the more what you're focused on, what you believe is kind of the trend of what we're going to see.
Yeah, I think we finally solved the Rubik's Cube here, Mehdi. I mean, it was a very, very difficult process, and all corrective waveforms are because, they take on a life of their own at some point. And, the larger the degree of trend, the more difficult it is to identify what's happening because it takes so much time for things to evolve. So, here's where we are at this point off the January 4th top in 2022, the market traced out what's known as a leading expanding diagonal. It's an exceedingly rare pattern that, there have been, a few documented incidents of this in the last 20 years. And it's a very valid Elliott wave form, but we're seeing it at primary degree of trend, which is very, very rare. And it took a long time. It took almost 9 months for it to completely unfold. And what really tricked us is the fact that the fifth wave ended up being a truncated fifth wave. That is another rarity. And it typically occurs when you get a news event that is widely unexpected. And of course, where we saw the October lows occur, that was on a big announcement of CPI data that radically outwitted the street and surprised everyone to the upside. And we saw basically the fifth wave decline terminate early and reverse sharply higher. Now, we were okay with that. We had a count that made sense at the time, and we assumed from that level we'd get a bear market rally of some sort, likely wave two. And when prices carried up to the February 2nd high, we thought, okay, we saw our zigzag corrective waveform. The next wave down looks like it's going to be primary wave three down. And so our count kind of evolved that way. We were in the midst of a banking crisis. We thought, well, this is a catalyst. This makes sense. The Fed came in and threw $500 billion in liquidity into the market and stabilized the banking system. And that put an end to things and set the market up to see that zigzag pattern morph into what's known as a double zigzag. And we thought, okay, well, we figured it out. It's a double zigzag, but we were wrong again, okay? What turned out to be the case is that the period from December 13th to March 13th was a exaggerated flat corrective waveform. And once we saw the picture kind of break out to new highs above the February high, we could come to the conclusion that, all right, this is probably just a larger degree zigzag. And, it had a flat pattern in the middle. So the next leg is just going to be 5 waves up, and that should terminate. Well, it wasn't exactly that clean. 5 waves up were clear, but the fifth wave subdivided into 5 waves, and the fifth of the fifth wave subdivided into 5 waves that made identifying the terminal point of this corrective advance very, very elusive. And in fact, it overshot the 61.8% retracement, the 78.6% retracement, and just fell short of the 88.6% retracement, which is basically the 78.6% retracement squared, and so, or the square root of. And so with that, we're kind of we're thinking to ourselves, all right, maybe there's a push up to that 89% retracement level. We didn't get there. We retraced 84%, and now we've rolled over. And I think just looking at how things kind of kind of coiled into that final high on July 27th, I think that marked the top of this recovery rally, or counter trend advance, as we would call it, and marked the top of primary wave two. If that's correct, then we are rolling over into primary wave three down, which should be something of an epic plunge that will carry prices to new bear market lows that are substantially below the October 13th low. We have an initial target range that falls somewhere in the mid 2000s in S&P 500 terms.
It's funny, this section of the show you always throw in the mid 2000s to me, and it just gives me shakes every time. So all that said and done, Jeff, how are the market internals looking?
They're weak, and let me just let me move back one point. I throw that target out there, but I never put a time frame on it, right? And I think the biggest problem observers of this have is they're like, oh, you're wrong because it didn't go to 2000 overnight or next week or next month. The market's going to do what it's going to do. This is a long-term forecast. The arrow pointed down is just to illustrate the direction that we expect, not the time frame that we expect. And so be advised that it could take many, many months, if not years, for primary wave 3 to completely play out, and certainly cycle wave A. We have kind of a longer term horizon of about a decade before this entire supercycle corrective waveform completes. So if you can get your arms around, the time issue, or not get so focused on, is this going to happen by October 30th? It's not, okay? This is a very long-term sort of structural view on the market. And we think directionally we're headed there next. Now, I think as far as support levels are concerned, I think there's a number of them that we need to, respect. And that is these open chart gaps below, right? There's an open chart gap just below 4250. I think that'll be the next support. Once we break through 4438, which is kind of the level we're holding above or had been holding above. And I think once we get through that level, we should see a quick drop to 4240, 4250. And then a break of that could carry us all the way down to 4,000. That'll take out the major moving averages, the advancing trend line, and that should kind of seal the fate in a lot of people's eyes. So that's what we're focused on a short-term basis. The longer-term target, say 2,500 or so, that's months to years out into the future.
So
as far as internals are concerned, though, to answer your question, I got on a tangent there. Sorry. Three things are noteworthy. We've got very obvious negative divergences evident in the breadth, the momentum, and the net advancing volume studies here. We also see a plunge in momentum, which is the middle frame, just above the median line. A break below the median line would put us in a negative momentum regime. Breadth is already in a negative momentum regime, or a negative regime, and net advancing volume is basically 1-to-1 right now, which is certainly not bullish. Okay, rarely does it get much below that and stay below that. A bullish version of net advancing volume would be kind of 5-to-1 or greater. So anything between, say, 2 to 5 range is kind of neutral, and 1-to-1 is outright not good. Okay.
So how does investor sentiment tie into this as well?
Well, yeah, so we're showing a couple of different sentiment measures here in addition to the advisor sentiment that we talked about, which, obviously is exceedingly bullish, right? We look at the name exposure index, which is the top frame in this chart, and professional investors have reversed their position since last week. Last week, you might recall, they were leveraged 101.8% net long. That's a rare condition to begin with, but it spoke to how ebullient sentiment was toward equities among professional investors. That has dropped to 65.8 or 65.5% right now in just a week. And this is a 2-week moving average of survey responses. So, I think it's fair to say at this point that even the pros are a little nervous about what's going on. Now, we could take a look at individual investors. The AAII survey, which is the lower frame, shows that 2 weeks ago, we saw a peak at around 30% in the bear bull spread. That has dropped to 19.2%, but just down a percentage point since last week. So it's taken a couple of weeks for that to move from its kind of peak level in this recovery. There's no doubt that sentiment is beginning to roll over, and it's being led by professional investors. Individuals are following, and professional advisors are kind of the laggards at this point.
Well, everyone's ray of sunshine, the Magnificent Seven. How are they holding up?
Well, not good. Last week, there was only one of seven stocks that was in positive territory. That was Alphabet. The stock was up, I think, 1.1%. Like I mentioned earlier, NVIDIA was down a full 8.5% last week. And, everything in between, right? But most stocks in the Magnificent Seven, cadre, underperformed the equal weight S&P 500 with the exception of Alphabet. So saw some pretty significant underperformance by tech last week.
So, Jeff, obviously, you still publish every week your top picks, top actionable trade ideas, five longs, five shorts. So, I would urge our viewers to go sign up and get more information on that. But before we wrap, let's have a look at some sectors. Any standouts for the week? And you've obviously been talking about valuation basis and positioning yourself on a relative strength analysis as well. So, could you just talk us through this?
Yeah, absolutely. Three things that we've noted. Number one, energy has been a pretty significant outperformer for the last several weeks, and that's been driven by higher crude prices. And tech has been a big lagger. And last week we saw the biggest spread between energy and tech that we'd seen in quite some time, about a 600 basis point alpha in favor of positive alpha in favor of energy, right? Tech was down 3.5%. And energy was up 2.5%. And so, that being said, we kind of are advocating a long energy, short tech sort of positioning, or overweight energy, underweight tech sort of positioning. When we look at valuations, energy trades at about a 50% discount to the market, but tech trades at a 50% premium still. And we doubt that that premium is warranted. In fact, we think energy is trading very, very cheap. And, you can just look no further than Warren Buffett, right? What's he been buying? He's been buying Occidental, right? Buying it like crazy. He owns Apple, but he hasn't been adding to his position for a long time. It's a great franchise. Nothing wrong with Apple. It's just not going to be a great stock in the interim. So we're favoring energy in that, general positioning amongst sectors. But the rotation also supports industrials and materials, and we're starting to see some evidence of a bottoming in the defensives, especially with healthcare recently showing some improvement. And staples, utilities, all had pretty decent weeks the last couple of weeks. And so, that being said, we're encouraged by the fact that there is a rotation into defensive names because that is pretty supportive of our bear case right now.
Jeff, that was really fantastic. Thank you very much for clarifying that. And as always, really appreciate you sharing your thoughts from Alpha Insights.
Always a pleasure, Mehdi.
And I want to urge our viewers, don't forget, check out Jeff's content on Substack at hugeinsights.substack.com. Until next time, thank you for watching and good luck investing.